Connected. Good evening, everyone. I hope everyone is listening. So my name is Dheeraj Arora. I'm a qualified financial planner working with Suvit. Um, First of all, I want to wish everyone happy Holi. I know Holi is not like the same Holi like we used to have in India. I guess most of us are working today, working day, but yeah, just, this is one of the greatest festival we have. So we just want to teach our kids that this is who we are, and this is what we celebrate. Anyway, today's session is um, talking about financial planning. It's been there from so many years, but not many people are still aware of what financial planning is. So we had a chat together, me and Suvit, and we just want to educate on this platform everyone. What is financial planning, who should be doing it, what is involved in it, and sometimes you can do planning by yourself, and why planning is important. So today's session, I'm going to cover some basic concepts about what financial planning is and how everyone can use that styles or techniques or strategies and whenever they want to plan for their future, mainly from Australian perspective, because in Australia laws are different, tax rules are different, investment strategies are different, the number of investment solutions that are available in Australia is different. It's not like what we used to have in India. Some of them are similar. Then there are lots of state laws, federal laws, and we need to comply with all those. And sometimes there are a lot of tax effectiveness when we come to investments, or sometimes you get penalized if you don't follow those strategies. So we're going to talk about in a broader sense what financial planning is and what we need to do. When we start working, I know we work really hard coming from India and started here working in regular jobs and maybe starting your own business. So we walk down with day-to-day activities, and the last thing you want to do is sit down and plan for future. So today's session will focus on educating you, and so that you can understand what are the concepts. Can we have everyone on mute?
Guys, can we all be on mute, please? Thank you.
Thank you. And then in the end, we can take some questions and we can have interactive session if you are willing to ask. So I'm going to share my screen so that if you want to see some slides and read while I'm talking, we can, it will be much more easier. Yeah, can you see the screen? Yeah, all good. Okay, so this is my company, Australia Wide Wealth Services. So I operate my business from Caroline Springs, which is Northwest Victoria, but I look after whole Australia. I have clients everywhere. I've been in planning from last, I would say 18 years and 20 years altogether with the banking industry. And then I left bank and started my own practice. Just want to give a disclosure, a disclaimer that the information in this presentation is of general in nature. It does not take into your specific needs or circumstances. So you should look into your own financial position, objectives and requirements, and seek financial advice before making any financial decision. So today's session is in general in nature. I'm going to cover lots of different concepts. Baby's crying.
Nitesh, can you put yourself on mute, please? Nitesh and Shrikant as well, please.
Thank you. All right, let's talk about what financial planning is. I don't want to take a test and talk about financial planning, but in general, simple language, financial planning is an ongoing process to evaluate your current financial situation and your long-term goals. And it also have short-term goals as well sometimes to guide you how you manage your finances well and how to prioritize your spending and investing to help you achieve your long-term goals. But in simple language, when it comes to financial planning, we look into two aspects. One is wealth creation strategies. Another is wealth protection strategies. So what can
अरे
you
वो
do from
मैम को दे देना, उनके लिए भिजवाया है उस वाइफ ने ना.
so what can you do from here onwards, no matter what stage of life you're in, whether you're just young, started working, or you're halfway through, or you're close to retirement? There are a number of strategies everyone can use at different stages of life, so that you can continue to create your wealth. Maybe a little bit different way, because sometimes there are a number of strategies which we are not aware of. And there are a lot more we can do with a lot of other things available. So based on your individual goals, circumstances, your cash flow, everyone can do some kind of wealth creation. Some people have more cash flow, they can invest more. Some has less, they can invest less, but everyone can do some sort of wealth creation, which will help them long-term. More money you save, better off you will be in retirement phase or during your journey and enjoy your lifestyle. So in simple language, we'll say financial planning mainly focus on two areas: wealth creation strategies and wealth protection strategies. As I said, the laws that we have in Australia and the rules and regulation, whether it's tax or retirement planning or superannuation or investments, that you need to have, some professional advice. Like if you buy investment property, then what you need to do along with it so that you can get maximum tax benefits. You may need to talk to a broker to find out how you can structure your loan. And there are a lot of other things you need to do so that you can maximize your return. You can maximize your tax offsets and things like that. So you need to speak with some kind of specialists who are specialized in that particular investments or industry, so that they can understand and give you the right advice. Sometimes people just rely on Google, and whatever they read on Google, just follow it. And then sometimes they end up making wrong decisions. So I'll say, talk to a specialist. If you're looking for, planning advice, talk to a financial planner first to see whether you need that kind of investments or not, whether it'll be more appropriate for you. So financial planners will sit with you and understand your situation to see where you are, where you want to be, what strategies may be suitable for you, whatever you're thinking, whether it's right for you or not, what are the pros and cons, and based on that, they can recommend go this way or go that way, or maybe choose a different structure and all those things. But it's very important that you need to understand that you have some sort of SMART goals. We're going to talk about SMART goals a bit later, but it all tied up with planning, that what you do from now onwards so that you can be better off long term. So when we talk about wealth creation, it includes a number of strategies which focus on a lot of things. Mainly we talk about investment advice for a wide range of investments based on your goals. So there are lots of different investments available in the market. Some are, we have some data and we know how they have performed in the past. So that has a number of, like say, Australian shares, international shares, bonds, different types of bonds, debentures, different types of fixed interest investment solutions available, obviously cash in the bank and term deposit, which everyone knows, and property investments. And there are a lot of new concepts are coming as well. So if people don't have money to invest in property, they would like to invest in property indirectly. So you can buy part of the property or one fraction of the property by investing money, but you're still invested in property. So you can invest in commercial or residential. So all these, the new technology innovations has given us so much space to invest into a lot variety of different investments. Now, cryptocurrency is getting very hot. A lot of people wants to make quick money and they're moving toward cryptocurrency. So it's a hot topic at the moment. But for all these types of investments, it's better, you need to understand pros and cons and the risk involved. But if you are looking for wealth creation, so that's where the investment advice will help. Second area is when you invest, how you can reduce your tax, and at the same time grow your wealth. So that's one more area where a lot of people look into when it comes to wealth creation, because if you reduce your tax, you're improving your cash flow anyway. Then one thing which not a lot of people pay attention is super, because they think, oh, super, I'm going to touch when I'm going to retire. But you have like 20, 30 years to retire. If you don't pay any attention now, you may not be able to maximize it. So improving your super or retirement savings long-term, also part of your wealth creation strategies. And some people who are close to retirement and they have assets and they're looking to dispose and things like that, for them, retirement planning is pretty important because they're pretty close to retirement. And for some people, maximizing Centrelink pension entitlements are very important because they are above some asset threshold and they wanted to make sure that they meet assets and income test and they can get some sort of pension. Now for them, Centrelink pension payments are very important. So all these are, wealth creation strategies where, financial planning focuses on. Then there is wealth protection strategies as well. Like if you're making money, if you're growing your wealth, how you protect it. One of the big one, which a lot of people ignore, is estate planning. Now, estate planning involves mainly, you need to have a will, you need to have a power of attorney. So if someone passes away without any will, what's going to happen to the assets? Who's going to get the assets? If someone's situation is simple, husband and wife, all the assets are jointly owned, then usually there is no problem because the surviving spouse gets that. But if you don't have assets which are jointly owned, then there can be problem. And if you don't have a will, then you need to have a lot of runaround needs to be done. You have to spend a lot of money. If you don't have a will, probably you need to hire a lawyer and you have to pay a lot of money to sort out your estate. So if you have those documents beforehand, it will be much easier for family to manage it. And that's part of the wealth creation and wealth protection strategy. A lot of people say to me that, oh, I'm so young now, I don't need a will now. I'll worry about when I'm, in late 60s or things like that. But who knows what's going to happen tomorrow. So it's better to have all those things sorted beforehand so that you know who will be your beneficiary and how you would like your assets to be distributed. Another part of estate planning is you need to have a document called power of attorney. So again, laws are a bit different here. So I'll just give an example. Power of attorney helps you if you are alive, but you are in a difficult situation. So like if husband has a bank account, has 50,000 in it, the bank account is under husband's name, and he had an accident and he become paralyzed or he goes in a coma, and wife doesn't know the pass PIN number or she can't operate his account because she don't know the details, then there is no way wife can access those funds because bank won't allow because she's not authorized to use that account. But if she has a document called power of attorney, that kicks in if you're unable to take decision because of some sickness or anything or accident, the power of attorney will give power to that person to look after all your affairs. Different types of power of attorneys, that's important. One is medical power of attorney, another is enduring power of attorney, which is pretty common, that if you lose your senses, who's going to look after all the affairs? People get dementia, things like that. Then if you have those documents, which is really important, I wish nothing will happen to anyone, but these are the strategies which we generally people ignore, but it is important. Now, to make a will or power of attorney, we generally recommend you speak with your solicitor because they'll be able to sit down and work out, the plan for you, and act on your wishes. And because some people have complex situation. So it's important that you can cater for all your beneficiaries and things like that. Another part of estate planning is who will get your super fund if you pass away. These days people are buying properties through SMSF. They have super balance, they have life insurances through super and things like that. If you don't nominate the right beneficiary through your super, then the benefits will be stuck with at trustee level, and it can take maybe years to get it. So it's very important. You need to nominate who will be your beneficiary. A lot of people go online and nominate. That's not a binding nomination. So you need to do a binding death nomination where you need to list who will be your beneficiary. And by law, you can only nominate 3 people. One is your spouse, number 2 is your children, or someone is dependent on you financially. And third one is your estate. If you nominate your mom, dad, brother, sister, uncle, auntie, they're all invalid nomination. So super funds won't pay them, because trustees, if you go and download a form, who do you want to nominate, this is clearly stated who will be the legal beneficiaries who can get your money from the super fund. So if you go online and nominate someone, that's not valid. You need to fill a form. It has to be witnessed by 2 witnesses, and then it has to you have to renew that every 3 years. Now, a lot of super funds coming up with an idea is called non-lapsing nomination, means you do once, you don't have to do it again. So that's one area where it can be complicated. When you seek an advice, financial planner or your lawyer will be able to give you some ideas on, okay, whether it's a good idea to nominate your children, because sometimes if they are above 18, they may have to pay tax on it, which is not a good idea because they end up paying more tax. So they work it out as strategies for you. Then another wealth protection strategy, which a lot of people do or use or take into account, which I believe it's a good one, is you pass the risk to someone else. That's where the insurance companies come. You give them some premium and they look after you. If you pass away, that's where the life insurance comes. Or if you become disabled, they pay you a lump sum. That's called total and permanent disability. You may have noticed with your super fund, you already have these insurances, whether small or large amounts. So usually they come with your super fund. If it's not, then you can always apply. But if someone is covering, the insurance company is covering your risk, that if anything happens, you are paying premiums to insurance company and they're providing you $200,000 or $1 million worth of insurance, that if anything happens, the family is looked after or you are looked after. Another area which is very important these days is called trauma insurance. And a lot of people use that as a wealth protection strategy, that if you get diagnosed with something serious like cancer, heart attack, stroke, kidney failure, organ transplant, then trauma cover usually pays you a lump sum. To be honest, I've launched a lot of trauma covers than anything else, because every 1 in 3 get diagnosed with something serious at some point of time. So the chances of dying straight is slim. Usually people get diagnosed with something serious and they go on a treatment for a number of years and then usually they pass away. The trauma cover helps you in that interim time frame when someone is diagnosed with a condition. So think about if you have trauma cover for, let's say, $500,000, you had a heart attack, you claim it, you can go to work tomorrow if you want to. It has nothing to do whether you go to work or you don't go to work. It pays you if you get diagnosed with that condition. And it's tax-free money. And it's mainly designed so that you can reduce your debts and have a better treatment or take time off from work. And the last one is income protection. These are all personal insurances where people tend to focus when it comes to protecting their wealth and the family situation. So income protection usually cover some proportion of your income, like up to 70 to 80% of your income, if you are unable to work due to injury or sickness. So if you had an accident and doctor says you can't work, or you get diagnosed with some condition and you can't work for some time, then income protection pays you every month until you get better or until you have the maximum benefit period attached to that policy. So some super funds offer that, but usually they only cover you for 2 years, and the terms and conditions are very basic. But income protection outside super is always better because they have better benefits. You can claim tax deductions for the premium. one of the misconception is income protection premium, sorry, income protection pays you if you lose your job. But that's not the case. It's there to protect if you are in a difficult situation so that you can still pay your mortgage on time, you can put food on the table, family is not disadvantaged. But most of the people think, oh, it's not going to happen to me, which is pretty common, and I wish nothing will happen to anyone. But this is in general, when we talk about strategies, this is one of the strategy which everyone needs to look into while you are on a journey to create your wealth. Always expect the best, but always plan for worse as well. And there can be other wealth protection strategies, which depends on different circumstances, which financial planners will be able to assess that whether you need insurances or not, or you're better off without them, depending on what assets they have, what cash flow they have, what other backups they have, and things like that. So these are the two main areas where everyone needs to focus on, that how they can create wealth by investing, reducing tax, and improving their long-term savings. And at the same time, while they're on their journey, they also focus on protecting their loved one and themselves by having a good estate plan in place, having good personal insurances in place. The personal insurance is very hot topic in Parliament at the moment because a lot of insurance companies are shrinking. And there are lots of direct insurance available as well. When you go online and buy, if you turn on the TV in the afternoon, they're selling all the insurances on the TV as well. So those are direct insurances, which is pretty risky because they don't ask any question. They don't do any medical tests. So if someone is suffering from cancer, they call and take a life insurance and die tomorrow, will they pay? Probably not, because they exclude all sorts of things if you do it. So best way to go for is go for a fully underwritten insurance where the insurer will ask all those questions. If they want to do tests, they can do it. If they want to take a report from the doctor, they do it, so that at claim time you don't have any issues or any hassles. Because if someone is hurt and they are in the hospital, last thing they want to do is deal with insurer provider so that they can get a claim. So these are some hints and tips. Okay, so when we look into financial planning, we need to look into a lot of different dimensions to it. So focus is always wealth creation and wealth protection, but we need to make sure you have a good cash flow management, debt management, you have enough sufficient tax planning in place so that you can save some tax. Estate planning I've already talked about. Investment planning is where you're investing, whether these are the right investments for you or not, or if there is any other investments available. Similarly, retirement planning, insurance planning, education planning for children is also part of it. So when a financial planner or when someone looks into financial plan, you need to look into all sorts of areas. Look at the bigger picture, not only patchwork. Bigger picture is holistic, so that you're not leaving any gray areas behind. Then some people say, why do we have to plan? So again, it comes down to people's preference. You must have heard of this, note that a goal without a plan is just a wish. If I say, hey, I want to buy 10 investment properties, so can you buy me 10 properties? Probably he can't, because I won't be able to get that finance straight away. So you need to have a plan. Say, I'll buy one property this year. Once I build equity, I'll buy a second property in third year. So I have a plan in place that this is what I'm going to do. This is how extra I'm going to pay, and that's how I'm going to build my equity and how I'm going to buy one another property. So if you have a plan in place, otherwise just a wish. I wish I can be a millionaire, but that's not a plan. So if you're looking for financial planning, it's important you think about the bigger picture, where you are, where you want to be, what sort of strategies you need to use from now onwards, so that you can maximize whatever you have in a legal, tax-effective manner. Not everyone can do everything, but there may be some strategies which some people can do now, some other strategies you can do maybe in 3 years' time, Some strategies you can do in 10 years time, but at least you are informed about it, and you know that these are the different stages of life where I have to work on these strategies, and I can reduce my tax, maximize my savings, have plan for my kids, reduce my debts, and be better off long term. So it's a thought process for long term planning. So in the thought process, you need to think a lot of things. If you don't think it, then obviously the advisor will sit with you and discuss all that with you. So basically, you need to look into step number one: what is my current net worth? Like how much assets you have, what's your liability, where you want to be where do you want to reach, and then you need to set your goals. That what do you want to do? You want to buy a car in 2 years, or you're already married, or you're getting married, maybe you want to go for holidays, and or whatever, you want to buy property, or you want to save more money. So then you need to think about how much money do you need and by when, and you need to plan from now. And then you need to consider, okay, if I want to invest, how much risk I'm happy to take. Most of the people say they are not high risk taker. They prefer to go, moderate, which is not high risk and not low risk. And that's most of the people end up doing. But with the education, understanding the concept, they can take a little bit more aggressive approach if they have long term. And then where should I invest? That's also very important. So a lot of people just invest where they understand that, okay, I can see this investment, like property is one of the big one. A lot of people say, I want to invest in property because I can see the property. I can feel the property. But there can be a lot more different investments available, which depends on everyone's risk appetite. Now, I put down 10 reasons, but there can be many more reasons that why you need to plan for your future in terms of when it comes to financial planning. So there are a number of benefits. You can manage your cash flow effectively, so that you know this is your ins and this is your outs, and how you can put some money aside, or you can do with X amount with XYZ strategies or whatever it is, but you'll be able to manage your cash flow very well. You can manage your debts efficiently, that you can reduce them faster. You can streamline your investments. You can invest in right financial products. That's also very important. A lot of people do a lot of mistake when they read something on Google and invest somewhere. Sometimes they end up making wrong choices by investing in very high risky investments. Set the asset allocation right. I'm going to talk about asset allocation a bit later. Asset allocation is how much proportion you invest in all different investments. And then weed out some inefficient financial products. You may have an old investment solution that's going on, but it's not relevant anymore, but people don't even pay attention. Have a risk management plan, and that's where the insurances and estate planning comes, that if anything goes wrong, what sort of plan B you have, and that's also part of the financial planning. Set smart goals. We'll talk about that in a minute. Smart goals are very important. And then, for regular savings for you and your children, or whatever the objective you have, and have a blueprint to achieve the financial goal, so that this is what I've planned and this is what I have to do at different stages of my life. So I put down these 10 reasons, but there can be many more, but these are the main ones. Now I'm going to talk about now, the strategies that you need to focus on when it comes to wealth creation. And it's not new, but I'm just giving you in a slide so that we're just focusing on that. Whenever you invest, whatever kind of investment you choose, you need to have some basic fundamental strategy you need to focus on. So let's talk about that. So investing for future. Now, whether you want to invest in properties or shares or wherever you're looking to invest, just remember diversification is the key. So diversification is you're not putting all your eggs in one basket. So if someone invested, let's say, everything in one company's shares, for example, everyone says there is a one company and people said, oh, let's put money there because they're pretty good. And next day you find out they're going into liquidation. So you're risking all your money by investing in one asset. Similarly, some people say, I want to buy 5 properties in one suburb. If you buy everything in Tarnate, probably you may not get better outcome if you buy one in east, one is west, one in north, and so on, because you're diversifying. Now, if you put all your eggs in one basket, you're not reducing the risk, but you're increasing the risk. Now, the basket, again, what's the definition of basket? We need to think about how big your portfolio is. Are you focusing only on property? That's only one basket. So everything is in basket. If property market crash, which is highly unlikely, but it can happen, we have seen in the past as well, then your overall wealth will be impacted. So that's one strategy. Whatever investment you're going to do, diversification is the key. More diversification you have, less risk you're going to have. The second one is have a long time horizon for your investments. So nothing will happen overnight. If you want to grow, let's say, any plant or fruits, you need to start from the seed, and then you have to grow it, nurture it, give water, give fertilizer, and wait for some time. Same thing happens with the properties as well. Same thing happens with any other investment. So whenever you look into investments, you need to have a long-term horizon. That depends on your goal. Now this chart, I just picked up from one of the website. I guess the coloring is not that good, but you can see there are lots of lines going up and up. So these are all different investment solutions. Investments assets such as property, international shares, Australian shares, various types of bonds. And the red one is, I think, cash. So you can see that in last 30 years, even though markets were up and down, they're still going up and up and up. And here in last year, you can see everything went down except for cash. Cash is still, earning a little bit of return. So there was a dip in the market. Same thing happened in 2008 when GFC happened. But overall trend long term, and we have another 20, 30, 15 years for everyone to retire. So you can see the trend is upward. So if you have long term in hand and long term view on your investments, so you can see that these volatilities usually go away pretty quickly. Okay, you need to stay in the market. So don't rush, don't sell at a loss if you're looking for long-term investments. Whatever investments you have, whether you're buying a property or you're buying any other investments, make sure you have a long time horizon. And one of the other strategy, which I believe is also important, but it's difficult to time this one, buy low and sell high. So, in March and April last year, when the market, dipped like 30%, a lot of people got scared and, they lost 30% in their investments. Some of them said, I'm going to sell it now. So you're selling it at loss. And some people were smart, so they purchased it when the market were down and they made more money. So just don't panic, stick to your plan, and always think of the strategy.
Okay, sure.
Buy low and sell high. Okay. And so there will be a number of market cycles available, where there will be different stages.
Look, the trend, see trend, look.
Sorry, someone is talking.
Wait,
But this is one of the fundamentals.
Hi, Anand, can you put yourself on mute, please?
Look.
What do you put on mute?
Yeah.
Anand, thank you.
Okay, thank you for that. But this is just a common sense, that you're buying when the prices are low and selling when the prices are high. So I remember, in March when market dipped, Commonwealth Bank share dropped from $92 to $52 for maybe 2-3 days. And a lot of people jumped on it and purchased. And just within a month, it came back to $70, $80. So, if you are watching the market and you're looking for different investments and you're educated and you're informed about all these strategies, then you can think and you can plan ahead. Similarly, all the bank shares were down. They were like, ANZ was selling at $14. NAB was half. Even Westpac was a half. That was not even 1 year ago, less than 1 year ago. That they all almost came back to the normal price. So some people invested and they doubled the money, because you don't get these opportunity quite often, but just this is one of the great strategy you can think of. So imagine if you find out, in western suburb or eastern suburb, property prices are, discounted at the moment, you're getting 20% less. A lot of people will jump and buy because they know the property market may go up. That's what their predictions are. So they're buying at low price. Other thing you need to think about is risk versus reward. That's one of the key for investments, any kind of investments. There is one old saying, higher the risk, higher the reward. I'm not talking about gambling here. So if you take $20, put into Crown Casino, chances are you can win million, or maybe you lose 20. So higher the risk, higher the reward. But everyone have different risk tolerance, because different people have different life experiences, what they have seen their parents investing, and how they have invested in the past, and what sort of experience they have. And some people understand the market, some don't. So you will be rewarded if you take higher risk. But we don't want to gamble. We want to take appropriate level of risk, and which is important to consider along with your time frame. So if someone says, I have 500,000 and I want to invest for 2 years, I want to take highest risks, we will say, don't take high risk with it, because your time frame is only 2 years. But if someone says my time frame is 10 years, then they have more appetite to take more risk, because even if the market crash, we have time to recover. So when it comes to investing, very important to understand how much risk you want to take with that money and what sort of reward you're looking for. And that's another way to increase your returns, that whenever you're looking to invest in a tax-effective or tax-friendly investments to boost your return. So, in Australia, whatever you earn, you end up paying, marginal tax rate. It can be 30% or 40% or 50%, depending on your income. Whatever you earn, you end up paying that portion back to the tax office. But if there is a investment solution available where you're not getting some tax back on the returns, but you're also, getting some capital growth, then it's a smart investment, because you're having win-win solution or situation there. So that's why properties are very popular, because if you buy brand new property, you can get tax depreciations for it. You not only get the tax back, some portion of it, but you also property grow long term. And that's the reason a lot of people are investing. You'll be surprised, in some countries you don't get tax benefits, but still property is hot there. The other area is that you need to consider when it comes to investing in property is that when you sell the property, you have to pay capital gains tax. So if you sit down one day and work it out, that if I purchase the property for 500,000 now, and 10 years time, let's say doubles in value, becomes $1 million. During 10 years, I have paid X amount of interest, and I've paid Y amount of expenses, whether it's shire rates or property management costs and all sorts of costs associated with the property. And then when you sell it, you have to pay capital gains tax. And if you work it out, what is your effective net return, you'll be surprised, it'll be close to 4 to 5%. So I will say that's a 10-year time frame. You can double the property in 10 years. Because there are a lot of theories floating around in the market that you keep the property, it doubles in 10 years. That's why I picked up that number. So even though you get capital gains tax discounted, and you get some tax back throughout the years, but you need to consider all those factors when it comes to investing. Okay. So this is one of the strategies you can use to improve your wealth, where you're getting some tax back. The other thing is, another part of the strategy, start early and use power of compounding. If you start early, you'll be better off. You can save more. You can save more tax. You can accumulate more money. I remember Albert Einstein's quote there is very important, and I'll always tell my client the compound interest is the eighth wonder of the world. He who understands earns it, and he who don't understand pays it. So some people pay and some people earn. So early you start, better off you will be long term. Whether you start small savings now, you'll see in 30 years you have a lot more, or you don't do anything, then you have to borrow money to do a lot of things. So this is just an example here. If you save $25 per week, when you were young, this is just for a child. I'm, giving an example. And if you earn 5.5% interest, I know in the bank you can't get it, but if you invest it, probably you can. And you compound monthly. So you can see by the time you hit 50, you have $343,000 roughly by just saving $25 a week, which is nothing. So this is just an example. So if you start early, you'll be able to maximize your wealth, no matter how much you do. I'm not saying put $500 a month away in a savings. Do something rather than nothing. I'll show you one picture here. So you can see that this is just a mathematical calculation. If you have $1 for 365, one remains one, but if you do a little bit of improvement, I'm just talking about a little bit savings, you can see the impact. So doing nothing at all versus making very small consistent efforts will take you a long way. A lot of time people ask me, how much do I need to save in order to get $1 million at retirement, or maybe different figures. I put a slide here, some calculations to show you. If you earn 6% return, which is not hard to get, I'm not talking about cash. And if you started, let's say, age 20, and you were saving $361 a month, then by the time you hit 60, you'll get $1 million savings if you invest into those kind of returns. But if you start at 55, probably you have to save $6,071 every month in order to get $1 million by the time you hit 60. So early you start, you'll be able to make most out of it. Especially for children, if you're looking to save money for the kids, start now. Investing money in the bank won't help because there is no capital growth. Compounding is pretty zero, pretty much. At the moment, you're not getting, even 0.2, 0.3% return. And then whatever you end up paying half in tax. So if you're looking to save for long term, start now. Don't wait that I'm going to do after 2 years or after three years, because time is running out and you will miss out on compounding part. Okay, so that's about wealth creation. I want to talk about a little bit of SMART goals. So SMART goals are one of the easiest way to understand whatever I'm planning, whatever goals I have, are they realistic? The SMART basically is specific, measurable, realistic, attainable, and timely. So these are the acronym, the SMART. So if you know a specific goal that you have, why you want to do it, how you want to do it, you know all the ins and outs of it, and you can measure it, and it's realistic. It's not like, oh, I want to build a 4-story house on moon, so it's not realistic. But if I want to build a 4-story house in Ballarat, probably I can if I have a plan in place. And attainable and realistic goals. So I've just given you examples so that when you plan, you can understand, okay, am I using a SMART goal technique to work out my goals? So one of the examples, I want to save 50,000 in 3 years, and I will save $300 per week, and I'll invest these funds in moderatively aggressive investment plan and aim for 5 to 8% return. So you know ins and outs, you're specific about what you want to achieve. But if you say, I want to buy 2 properties in 2 years, but you don't know how, that's not a SMART goal. Whether it's realistic or not, no one knows. So when you plan and set your goals, It has to be realistic and smart. It's not like I want to be millionaire tomorrow. It's very hard to do it because we are not gambler or Joshi or things like that. So you need to focus on whatever cash flow you have, how you can utilize it. So these are the number of strategies that you can use when it comes to wealth creation. So I'll just do a quick recap. Diversification, always look for diversification, have a long-term plan, if possible, buy low, sell high whenever the opportunity comes, because no one can time the market, and have risk versus reward strategy, how much risk you're willing to take. Higher the risk, higher the return. Look for tax effective investments so that the tax benefits can be added to your overall returns. And the most important one is start early. When is the good time to invest? Now, just now, just start now, because you have long time in hand. Later you do it, lesser the savings will be. And do some kind of investments. Don't leave it, because if you do something, it's going to make massive difference in your retirement or long term. Let's talk about wealth protection strategies, which we talked about. The financial planning focus on two areas. Now, when we come to wealth protection, we'll look into risk. What are the overall risks everyone is exposed to? So we assess the risk, or you assess your own risk, that what sort of plans I have, what sort of plan B I have. Anything goes wrong, who's going to look after me? A lot of people think that if something happens to me, the government will look after me, but that's not always the case. So you need to assess your risk. You need to understand, can I control this risk, or can you identify the risk to start with? Can you control those risks? Can you avoid that risk? Or what sort of risk management plan you have? So all those things you need to think about. Now, whether you invest in a property, so you need to think about the risk associated with it. Whether I get a rental income consistent, what if I get a bad tenant? Who's going to deal with it? All these laws are changing every day. Tenants law, where owner have less powers and tenants have more. All these can be a risk to a tenant, so to the owner. That's only one example. But other one is, if anything happens to you, a couple working, if one of them is not working, or one of them lose job, your cash flow is impacted, how much backup you have, what is your exit strategy, can you control all those risks? You need to think about the worst case scenarios first before you go into any kind of investments, to make sure you have enough backup. Now, what can happen? What are the risks? It's very difficult to define, but I put down some major personal risks that everyone can be exposed to. First is income risk. Death is one, disability is one, unemployment and aging. So they all can have an impact on your income or the income of the family. Then expense risk, you have high expenses, somehow something happens, suddenly something break up and your car blown out, or you need more money to fix things. So expenses can go high, emergency expenses can come up, and that can have a really bad impact on the cash flow. Investment risk, market falls, property market is impacted, interest rate goes up, market gets impacted, valuation gets impacted. Inflation is another one, depreciation, destruction, or theft. If something goes wrong, do you have the right protection in place for the assets that you hold? Debts and credit risk, too much debt. I've noticed a lot of people keep borrowing to the maximum, 90%, 80%, because they want to buy a property, and they don't consider the risk. All they say is, I need the property, I want to buy. I'm happy to take maximum loan. But what sort of plan B you have if anything goes wrong? If the valuation comes down, if the rental income goes down, if the property is not, get tenanted for some time, how are you going to manage it? What sort of backup you have? All these can cause a lot of, these are main risks, and that can have a big impact on the cash flow and on your wealth creation plans. Then risk management strategy. So this is mainly from personal insurance point of view. You know, death can happen, or you're not going to work ever again. That's another risk. Major illness like cancer, heart attack, things like that. You can't work for short term. So you need to think about how I'm going to manage it. You know, and some people say, oh, I have enough cover through super. And when you look into your super, you have $200,000 worth of cover, and your mortgage is $500,000. And then when you find out when they pay you, they're going to pay tax on it. So you won't even get that much money. So you need to have a proper planning in place to make sure that you have plan B while you're on that journey of wealth creation. And then you need to make sure you have insurance. Now in Australia, it's funny, you need to have insurance for everything, you know, life insurance, health insurance, disability insurance, car insurance, home insurance. Now pet insurance is also very popular because vet bills are very expensive. People take cat insurance for cat and dog and things like that. And in reality, you know, insurance premium is just covering the risk. It's a dead money until unless you claim it and you see value in it. But you can't ignore it. It's like catch 22. You need to make sure you have enough risk management plan. If anything goes wrong, then you have sufficient plan B so that your family is looked after. In Australia, I have seen overseas, you know, you have very limited support from the family because you came here alone with the family and you're looking after, but there is no mom and dad who can look after you. You have to look after yourself. That's why it's important to look into these kinds of backup plans. Now, is it worth it having personal insurances? That's the question I always ask by a lot of clients. Now, death or illness or disability, can anyone predict? No one can predict. I wish nothing will happen to anyone, but I can share some stats. What are the chances of claiming? You know, critical illness or trauma cover, the one I was talking about earlier, you know, covers for if you get cancer or heart attack or things like that. You can go to work, but if you get diagnosed with cancer, probably you don't want to go to work, you focus on your health first. So if you have trauma cover or critical illness cover, that's what they say, of $500,000 or $1 million, they'll pay you that money while you're alive so that you can pay your debts, have money for the children or your treatment. You see the best doctor in the world rather than waiting in the private hospital, public hospital, or whatever it is. You have that money to do so. And that's where trauma cover will help. Now, I've seen 1 in 3 chances of claiming, which is very high. You know, if you buy a lottery ticket, 1 in million, or probably 0.1 in million, you don't even have chance to buy a lotto ticket. But with trauma cover, very high chance. Life insurance, 1 in 10, not many people die. Naturally takes it with the medical advancement, people lives longer these days, but the chances of dying is based on the statistical claims is you know, it's very low. And a lot of people take life insurance and trauma cover, so this is pretty bizarre because the thing, if they die, then family is looked after, but they don't want to look after themselves or family when they're alive. Income protection is also very high, 1 in 4. A lot of claim that we have seen comes from back. You know, people hurt their lower back or bad back and stress. A lot of people on stress claim at the moment. You know, stress at work or family or relationship. If you get diagnosed with stress or depression, last thing you want to do is go to work and you lodge a claim, they'll pay you. But not all policy pays. You know, the one that you buy online, they don't pay. The one that you get through super, some of them have a blanket exclusion. Talking about the good policies in the market. And total and permanent disability is the least claimable, that if you're unable to work ever again, then TPD cover pays. So you'll see life and TPD are the least claimable looking at the stats, but these are most of the people have these 2 covers, not these 2. So something to think about. Okay, so let's talk about the other strategy, the estate planning. So I've talked about in a lot more detail before. Estate planning has wills, power of attorney, who will be your beneficiaries. If you have young family, if something happens to you, who will look after the children if husband and wife both pass away. A lot of clients of mine, they ask, if something happens and, to them and they pass on their investment properties to their kids and they get married to some other, partners and they get divorced, what's going to happen to their properties? Now, to counter and to protect all those assets, you need to talk to a lawyer to make sure you have everything written in the will, and they'll give you proper advice that if anything happens to you, you worked hard to build these assets and you don't want to pass on to someone else because of some family matters or family separations and things like that. You can protect your assets if you plan for it. So that's from estate planning point of view. And as I said, take professional advice because Google can't give you answer for everything, because in Australia, personal advice is highly regulated by ASIC. So whatever I say can be classified as personal advice because financial planner said it. So whoever says I'm an advisor and they don't give you advice in writing, they are not giving you the personal advice. So by law, a financial planner needs to spend time. It may take 3 to 4 weeks to do all the planning work. They need to give you a financial plan in writing so that this is what we recommended, this is how we are better off, and these are the strategies or the product we have to focus on to increase our wealth. You may have noticed online people are saying, I'm a property advisor, but end of the day, all they're doing is selling a house and land package to you. They won't say it's appropriate for you. They won't say they have done any research. All they're doing is just selling. And they can't give you in writing that this is what we recommend. You should have it because you're going to double the property in 10 years, because they can't give you any advice. So it's highly regulated. In ASIC Watch, everyone, whoever gives advice, we need to make sure it's in the best interest. So our focus is not to sell you any product, look into strategies for your long term. Okay, so that's the end of my presentation. So these are my details. So if someone wants any advice or they have any questions and things like that, I'm happy to guide them through. If you are confused about something, some people say which super is better for me and all that thing. So, so if you're confused about any matter in relation to planning, I may be able to help you with some strategy. I may be able to guide you through like to whom you should contact so that you're not trapped in all those dodgy scams, usually which is going on. All right, question time. So with questions, anything anyone wants to talk about?
Okay. We'll basically, anyone who has any questions, feel free to put them in the chat box. We'll start with the first one that we already have for Dheeraj. I want to know about any investment or savings plan for my child, something very similar to schemes in India for girl child, which can build up a good sum of money by the time the child gets to an adult age.
Yeah, definitely. There are lots of different investments, especially for children, that are available. I would encourage you to maybe contact us and we'll be able to see what kind of investment solution. There are a number of them available and they're very tax effective for you because you can't open investment under child's name due to tax reason. It has to be open under adult's name, but over a long period of time, you don't pay capital gains tax and things like that. It's very tax effective and it's very popular.
Okay. The next one is what are the charges for financial planner services?
The charges depends on number of strategies. So what I do generally, I give you first appointment at no obligation because my license says if I can't add value, I can't charge you. So I'll sit down with you, or any planner you go to. So they'll review your situation. They'll see, okay, where you are, where you want to be. Is there any strategies which may be suitable for you? They'll talk about it and they'll say, okay, these are the things you can do and this is the things it can help you a long way. And if you say, yes, I want to do one strategy or all of them, or you want holistic advice, the fees involve creation of a plan, which takes maybe 3 to 4 weeks. Usually it's between 60 to 100-page document. For us to do all the research, paperwork, documentation, and then implement all those for you, and then pretty much review it every year. So very hard for me to tell you, how much the fee will be, but on an average, you'll be looking at, for a comprehensive plan in the industry, it can be simple plan starts from maybe $1,600, and the other one, the comprehensive, can go to $3,000-4,000. That's what I have seen in the market, but I charge very reasonably depending on the value add. If I can add value, then I'll say this is what I can do. Now, if sometime the fee can be charged from super as well, so we'll look into all those options depending on what is best for you. But I will say it's best to have a review done so that you know whether you need financial advice or not. Sometimes you don't need it. Sometimes you're doing everything right. We'll say, keep doing, maybe tweak few things here and there. And sometimes we'll say, yes, you need some sort of, you need some side of hand holding long term. And that's where nothing comes free. We need to pay a lot more to keep the license. ASIC may have also increased the fees and things like that. It's very expensive to run financial planning business here in Australia.
Okay, next question is, if I have a will, do I need to update it regularly if there are no changes at all?
If there is no significant change in your life and you feel that it's all relevant to your circumstances, then you don't need to update will. But whenever anything changes significantly, like if you have a child or you purchase an asset, it is not listed there, or you have a significant event in your life like breakups and things like that, then I'll highly recommend you review it. And if you make a will through WillKit, avoid doing that. You need to speak with the solicitor.
Okay. The next one is, I certainly would be interested in living will with the lifestyles we are all leading these days, as it's unpredictable. So please talk me through the living will process, and any reliable advice would be much appreciated. Beside, what are the points to be considered when one is writing a will?
I guess it's a solicitor question. So I'm not qualified to give any solicitors advice. That's a legal advice. So I can't say much about it. It depends on everyone's different circumstances. You'll be better off talking to a solicitor. And I'll recommend go with a estate planning specialist. Don't go to any lawyer. Okay, so if you Google search estate planning lawyer, you'll be able to find few who specialize in making wills, guardianship. Estate trustees is one of the famous one. I think they have office in Footscray, but obviously, I don't know, they charge more because they're a big company. If you can find someone who charge less, you can talk to them. And lawyers are not cheap, I'll tell you. They charge for everything.
Next one is, can we buy insurances outside of super but paid from super?
Yes.
Okay.
Yes, you can.
Yogi, I think Dheeraj said estate planning, not state planning. All type of insurances can be bought outside super?
Yeah, all types of insurances can be purchased, but you can't pay for all the insurance. Like trauma cover, you can't pay. Income protection, we say pay outside super because you get tax deductions for it.
Uh-huh.
But you can buy everything outside, pay from your cash flow if you don't want to have an impact on your super. But I'm just saying a lot of people get insurances through super. I'm not saying buy always from super because super policies are very limited.
Okay.
So just want to give you one example. If you read the product disclosure statement of your super statement, the disability cover has any occupation definition. So what does that mean? It means if you had an accident and you can't work in any occupation, then only they're going to pay. So like if someone is a doctor or a lawyer or IT specialist or an accountant, let's say you are driving a car, you had a car accident, you had head injury, you lose your senses. Now, you don't even remember your name. You don't know what accounting is. Can you work in any occupation? Yes, you can work in, a factory, pack soap in a box, or, pack parcels and things like that. But can you work as an accountant? No. So in that case, the disability cover that you have through your super, they're not going to pay you. So it's a big gray area for professionals. So if you read it, that's why the statistics are very difficult. The one I showed you, disability claim 1 in 20. So for professionals, we'll say take always on occupation. So I have a lot of doctors, dentists, lawyers, accountants, programmers. They don't want to work in odd jobs. So if you can't work in your own occupation, you still want to get paid if you become disabled. So like a surgeon, his hands are the most important thing. So if he has any occupation through super, and if he has some condition where he can't operate people, the super fund is not going to pay him. But if he has an own occupation, he get paid that money and he can take that money and relax. Don't have to work ever again. So that's the difference.
Okay. There's a question. I had a bad experience recently with Bupa. They say they can't disclose the coverage upfront unless we provide an item number of the medical treatment, which they say only the hospital can provide. I'm not happy with them. Do you have any recommended private health insurance provider from your experience?
I don't deal with private health insurance. I deal with only personal insurances, because private health insurance is general insurance. You can go online and read the product and take it. It has nothing to do with planning. Like car insurance, you go online and take it based on what features and benefits you want. But with all these personal insurances like life insurance, disability, trauma, income protection, we have to look into tax effectiveness through super, outside super definitions and things like that. So we work on strategies and then we look into product to see which one suits you better. So if you're talking about car insurance, landlord insurance, general insurance, public liability, or health insurance, I'm not the right guy to talk to, because they are general insurance. You don't need advice for that. You go online and read the PDS and whatever suits you.
Okay, the next one is the final product of financial planning a 50 to 60 page strategy document, or does it go a step ahead to action? Are there any investment management services? Say I want to invest 10,000. Would you invest on the client's behalf?
Yeah, so what we do is, the document, varies number of strategies. So usually 50 to 60 page document, which talks about strategies and product and projections and calculations and assets disclosures and risk disclosures and all that. But yes, we do invest and on behalf of you. And we discuss with you what is more important to you based on your plans and things like that. It's not like I'm going to invest everything in one share. So I don't give direct share advice. We give diversified investment advice. In India, they call mutual funds. That's more similar kind of situation, but there are a lot more tax effective investments, which is popular here. So we create plan, implement the plan, and if you want ongoing service, we'll give ongoing service. We'll review once a year. And of course, for that, charges apply depending on if you're monitoring it and changing every 3 months, 6 months, or 1 year.
Okay, the next one is, can we use our super for a property investment?
Yes, you can, but you need to have SMSF set up. Again, you need to consider whether it's right strategy for not, right strategy or not. 8, you say you need to have at least $300,000 to invest in super, but investing in property through super can be very expensive. So I'll encourage you to go online on Money Smart. That's a government's website. Click on, or maybe search investing in properties through SMSF, Money Smart. That's a government website, Essex website, and it tells you pros and cons of doing it. Yes, if you talk to us, we'll do an assessment and tell you whether it's a good idea or not. Because the main focus of your super is that you have enough in retirement. And if it ticks the box, we'll say, yes, it's a good strategy, you can do it. And then, how to do it, we can only give you strategy. You have to go and search a property by yourself.
Okay. What's the lowest super balance you recommend for SMSF creation?
ATU says at least 300,000. Otherwise, it's not tax effective. It's not cost effective, because to set up SMSF, different people charge different money. On an average, you need $2,000, $2,200 to set up and manage. And then you have to pay similar fees every year for audits and paperwork, taxation. And you're not going to do everything by yourself. Accountant will do it. And if you do any mistake, your super will become non-compliant, means you'll pay 45% tax instead of 15. So that's why we need to do an assessment to see whether SMSF is right for you or not. A lot of people come and say they want to open SMSF. They don't have a clue what is involved. For some people, it's perfect, that they're better off in SMSF because they can do a lot more through SMSF. Whereas some can't, depending on your balance and how you want to invest.
How much would be a comfortable super amount for a couple at the time of retirement?
So that depends on how much income you want to generate at retirement phase. So you need to do a budget to see, okay, how much I'm spending now. So let's say if you're spending $1,000 a week, you need $52,000 a year to live on. You need indexation to it, inflation to it. So let's talk about in today's dollar. So if you are spending that much, and in retirement phase, if you can earn 5% return, so when can you get 52,000 return? What balance that should be, that we are looking for with indexation and all that. So that'll be a ballpark figure. So $1 million will give you 50,000. I hope I answer your question.
Yep. Any other questions? No, it looks like we are done, Dheeraj.
Excellent, excellent.
All
All right.
Amit, I can pass Dheeraj's contact details to you.
So if you have any question, and I just want to tell you there are a lot of scams happening, through Facebook and everywhere. If someone says they're advisor, they're giving advice on something, and they're not spending time and giving a financial plan, which is a legal requirement, then you need to be suspicious, because probably they're selling you cryptocurrency, or probably they're selling you, off the plan investment property somewhere, and they're going to get a clip of 30, 40,000. I've seen people running lots of seminars that you can buy one property now, in 10 years you can buy 10 properties, and then make people excited, and you go and sit down and they sell you SMSF and put everything, and then they'll sell you property in Toowoomba, which is like already 30,000 inflated in price, and then you're stuck there forever. So I would say, control your emotion and do your research before you jump onto anything, because there's a lot of scams happening. Excellent.
Okay.
Thank you very much for everyone joining in, and happy Holi. I know it's already, days past, but feel free to contact Suved or myself. We'll be more than happy to assist you.
Thanks a lot for your time, Dheeraj, and thanks everyone for joining in. Have a lovely evening.
Excellent. Thank you. Good night.
Good night.
Bye-bye.